Barter System. Barter System marks the dawn of trade, where goods were exchanged for other goods without money. Around 6000 BC, this system flourished. Communities traded items like salt, cattle, and grains. This method, however, struggled with determining equal value and perishability of goods. Commodity money. Commodity money emerged when certain items became standardized trade units around 3000 BC. Items like shells, beads, and metals were used. This system improved trade efficiency, but still faced issues of portability and consistent value, leading to the development of more advanced forms of money. Metal coins. Metal coins appeared in 1000 BC, revolutionizing trade. Durable, portable, and with intrinsic value, these coins made transactions easier. Kings and empires minted their coins, symbolizing authority. However, carrying large quantities was cumbersome, paving the way for lighter alternatives. Paper money. Paper money began in China around 806 AD. It was a game changer, offering ease of transport and use. Initially representing a promise for metal coin exchange, it gradually became the norm. This period saw the rise of banking systems to manage paper currency. Gold standard. Gold standard, adopted in the 1870s, linked paper money value directly to gold, ensuring stability. Countries agreed to convert paper money into a fixed amount of gold, creating a global standard. However, the Great Depression in the 1930s highlighted its rigidity and limitations. Banking evolution. Banking evolution, since the Renaissance, transformed money management. Banks started offering storage, loans, and interest-earning deposits. This system played a crucial role in economies, but also led to complexities like inflation, bank runs, and the need for government regulation. Credit cards. Credit cards emerged in the 1950s, offering a new level of convenience in spending. Initially, for the wealthy, they became widespread, allowing people to borrow money for purchases and pay back later. This innovation boosted consumerism, but also introduced the concept of credit debt. Electronic banking. Electronic banking took off in the late 20th century, enabling online transactions. This technology allowed for quick, global financial exchanges and account management from anywhere. It streamlined banking, but raised concerns over security and digital divides. Cryptocurrency. Cryptocurrency, born in 2009 with Bitcoin, introduced a decentralized digital currency system. It operates independently of traditional banks, using blockchain technology for secure transactions. Cryptocurrencies represent a significant shift, but face challenges in regulation and acceptance. Mobile payments. Mobile payments, which gained traction in the 2010s, made transactions more accessible via smartphones. Apps like PayPal, Venmo, and country-specific platforms revolutionized how people send and receive money, emphasizing convenience and speed. This trend continues to grow, reshaping the payment landscape. Inflation. Inflation, an age-old phenomenon, decreases money's purchasing power over time. It's a critical economic indicator, affecting savings, investments, and living costs. Governments and central banks strive to control inflation through monetary policies, but it remains a persistent challenge. Global economy. The global economy, especially post-World War II, highlighted how nations' economies are interconnected. Currency exchange rates, trade policies, and international debts significantly impact global financial health. This interconnectedness has led to collaborative efforts like the International Monetary Fund, IMF, for global financial stability. Stock markets. Stock markets, existing since the 1600s, offer a platform for buying and selling company shares. They reflect the economic health of companies and countries. While offering investment opportunities, they also pose risks, as seen in crashes like the 1929 Great Depression and the 2008 financial crisis. Fiat currency. Fiat currency, unlike commodity-based money, has value because governments declare it legal tender. It's not backed by physical commodities, but by trust in the issuing government. While flexible, it's susceptible to mismanagement, leading to hyperinflation in some countries. Wealth disparity. Wealth disparity, a long-standing issue, reflects the uneven distribution of money among populations. It affects access to resources, healthcare, education, and the overall quality of life. Efforts to reduce this gap involve policy changes, education, and economic reforms. Interest rates. Interest rates, set by central banks, influence borrowing and spending. Lower rates stimulate economic growth by encouraging borrowing, while higher rates aim to control inflation. These rates impact everything from personal loans to national economic policies. Money laundering. Money laundering, an illegal activity, disguises illegally obtained money as legitimate. This practice undermines financial systems and fuels criminal activities. Governments and international bodies enforce strict regulations to combat money laundering and its implications. Digital wallets. Digital wallets, rising in the 21st century, store digital versions of cards and cash. They facilitate easy, secure transactions and are integral to e-commerce. As they gain popularity, concerns about digital security and privacy have also escalated. Remittances. Remittances, money sent by migrants to their home countries, play a crucial role in many economies. They support families and contribute significantly to national incomes. Digital platforms have made remittances easier and more affordable. Quantitative easing. Quantitative easing, a policy adopted during financial crises, involves central banks buying securities to increase money supply and stimulate the economy. It aims to lower interest rates and increase lending. While beneficial in short term, it can lead to long-term risks like inflation. Counterfeiting. Counterfeiting, the illegal replication of money, has been a challenge throughout history. It undermines currency value and trust in the financial system. Governments use sophisticated technologies in money design and printing to prevent counterfeiting. Savings accounts. Savings accounts offered by banks allow individuals to deposit money for future use. These accounts often earn interest, providing a safe way to store and grow money. They're a fundamental part of personal finance management. Debt. Debt, money borrowed to be paid back with interest, is a common financial tool. It enables investments like education and housing, but can lead to financial strain if mismanaged. Understanding debt and its implications is crucial in financial planning. Exchange rates. Exchange rates determine how much one currency is worth in terms of another. They fluctuate based on economic factors and impact international trade and travel. Understanding exchange rates is essential for businesses and individuals engaged in international transactions. Financial crises. Financial crises, like the 2008 global recession, occur when key financial assets suddenly lose a large part of their nominal value. They can lead to severe economic downturns, affecting employment, savings, and government policies. Preventing and managing such crises is a key economic challenge. Budgeting. Budgeting involves planning income and expenses to achieve financial goals. It's a crucial skill for personal and governmental financial health. Effective budgeting helps in managing debt, saving for the future, and ensuring financial stability. Taxes. Taxes. Compulsory contributions to government revenue, fund public services and infrastructure. They vary by country and income levels. Understanding and complying with tax laws is essential for individuals and businesses. Economic growth. Economic growth, measured by gross domestic product, GDP, indicates how a country's economy is expanding or contracting. It impacts employment, income, and quality of life. Governments aim to stimulate growth while managing challenges like inflation and environmental impact. Central banks. Central banks, like the Federal Reserve in the US, manage a country's currency, money supply, and interest rates. They play a crucial role in stabilizing economies, implementing policies to control inflation, and responding to financial crises. Future of money. Future of money is an evolving concept, with digital currencies and technologies reshaping how we transact. While innovations promise efficiency and accessibility, they also bring challenges in regulation, security, and economic equality. The journey of money continues, adapting to the needs of changing societies.